You're watching the market. Price is consolidating. Your internal voice starts, "This is definitely going to break higher. I can feel it." The volume profile suggests accumulation. The pattern indicates continuation. This is absolutely going up. You enter a long position based on this prediction. You're certain. You've analyzed the signs. You know what's coming. Price breaks lower. Your prediction was completely wrong. You lose $340. But here's what's actually devastating. This wasn't the first time. You do this constantly. You predict the market will go up, it goes down. You predict it will go down, it goes up. You predict consolidation, it breaks out. You predict breakout, it reverses. Your predictions are consistently wrong, yet you can't stop making them. You enter every trade with certainty about what will happen, and the market repeatedly proves you don't know. And until you understand why your brain compulsively predicts unpredictable outcomes and how prediction-based trading destroys your results, you'll keep entering trades based on knowing what will happen instead of responding to what is happening. The psychology of market prediction. Here's what's actually happening when you compulsively predict market movements, and why certainty about future price action is psychologically irresistible but strategically destructive. Market prediction is your brain's attempt to convert uncertainty into certainty. Markets are inherently uncertain. Thousands of participants making millions of decisions create genuinely unpredictable outcomes. But your brain finds uncertainty psychologically intolerable, so it creates predictions to replace uncertainty with false certainty. This isn't conscious or voluntary. Your brain automatically generates predictions about future events, especially when facing decisions under uncertainty. These predictions feel like insight, analysis, or pattern recognition. They're actually psychological defense mechanisms against the discomfort of not knowing. Psychological mechanism 1. Control illusion through prediction. Humans have a powerful psychological need for control. When you predict what the market will do, you create the illusion of control over an uncontrollable system. "I know the market will go up" feels like you have power over the outcome. This illusion provides psychological comfort. Prediction makes you feel like an active participant shaping outcomes rather than a passive observer responding to outcomes. But the cost is you make decisions based on imagined future scenarios rather than actual current conditions. Your trades are based on fiction, your prediction, not reality, price action, and probability. Psychological mechanism 2. Pattern completion drive. Your brain is a pattern recognition machine. When it identifies a partial pattern, it experiences powerful drive to complete it. You see price forming what looks like the beginning of a bullish pattern, and your brain automatically completes the pattern in your mind. This looks like accumulation, which leads to breakout, which leads to rally. Your brain has completed the story before the market completes the pattern. This pattern completion feels like analysis, but is actually imagination disguised as prediction. Psychological mechanism 3. Narrative construction need. Humans think in stories. Your brain doesn't just see price data, it constructs narratives to explain and predict price movement. "The market is consolidating before the next leg up" is a story your brain creates to make sense of random price fluctuations. These narratives feel explanatory and predictive. They give meaning to chaos, but they're fictions your brain invented, not objective market realities. Trading these narratives means trading your imagination, not actual probability. Psychological mechanism 4. Ego validation through being right. When you predict the market correctly, you experience ego validation. "I was right, I knew it, I can read the market." This validation is psychologically rewarding, triggering dopamine release and feelings of competence. Your brain becomes addicted to this validation, driving compulsive prediction making. You're not trying to make money, you're trying to be right and experience the validation that comes with correct predictions. The 4 types of market prediction. Different prediction patterns destroy trading in distinct ways. Type 1, directional certainty prediction. This is definitely going up. This is clearly going down. You analyze a setup and conclude with certainty about future direction. Your prediction isn't probabilistic, higher probability of up than down. It's deterministic. This will go up. This certainty prevents appropriate risk management because you know what will happen, making stops feel unnecessary. Why protect against something that won't happen? Your internal dialogue. This is obviously bullish. All the indicators confirm. This is going higher, no question. I'm absolutely certain about this direction. Type 2, price target prediction. You don't just predict direction, you predict specific price levels. This will hit $47.80, not might or could potentially, will. You've calculated the exact future price. This creates attachment to specific outcomes. When price doesn't hit your predicted target, you hold past your stop or exit too early, both destroying your risk management because reality doesn't match your prediction. Your internal dialogue. Based on the pattern, this should reach exactly $47.80. That's where I'll exit. I can see it clearly. Price will move from here to there. Type 3, timing prediction. You predict not just what will happen, but when. This will break out in the next 30 minutes. This consolidation will end by tomorrow. You're predicting temporal specifics of unpredictable events. This creates impatience and premature action. When your timing prediction doesn't materialize, you abandon valid setups or force trades that haven't developed because the market didn't follow your timeline. Your internal dialogue. This consolidation is about to break. I can tell it's building pressure. The breakout is coming in the next hour. I need to be positioned before it happens. Type 4, scenario prediction. You construct elaborate multi-step scenarios. Price will pull back to support, consolidate, then break higher to resistance, where it will pause before the next leg up. You've predicted an entire sequence of future events. This scenario becomes your expectation. When the market deviates from any step, you're psychologically unprepared, leading to confused decisions and emotional reactions because reality isn't following your script. Your internal dialogue. I can see exactly how this will play out. First, it drops to $45.20, consolidates for 2 days, then rallies to $48. I can visualize the whole sequence. Meet Yale, the trader who predicted his way to losses. Yale had been trading for 7 years when he realized his biggest problem wasn't bad analysis, it was that he was analyzing the wrong thing. He was analyzing what would happen instead of what was happening. Yale implemented a new journaling requirement. Before every trade, he wrote down his prediction about what the market would do. After the trade, he compared his prediction to actual market behavior. Over 3 months, the data was humbling. Trades where Yale made specific predictions. Total, 78 trades with documented predictions. Predictions correct, 31, or 40% accuracy. Predictions wrong, 47, or 60% accuracy. Prediction accuracy was worse than random. Performance analysis. Trades where prediction was correct. Win rate, 68%. Average profit, $385. Trades where prediction was wrong. Win rate, 22%. Average loss, $290. But here's the crucial insight. Yale's trading strategy had a proven 64% win rate when executed without prediction bias. His predictions weren't helping his decision-making, they were destroying it. Why predictions destroyed results? When predictions were correct, Yale overextended positions, held too long, or added size because he was right about direction. This occasionally produced larger wins, but more often turned winning trades into break-even or losers. When predictions were wrong, Yale fought the market. He held losing positions waiting for his prediction to materialize. He exited winning positions early when price moved correctly, but not for his predicted reasons. He re-entered losing trades because he was sure his prediction would eventually be proven right. Yale's prediction habit cost him approximately $8,200 over 3 months by causing him to override his strategy signals in favor of his predicted scenarios. Inside Yale's mind, trading a prediction instead of reality. Yale documented his internal dialogue during a typical prediction-driven trade. The pattern recognition and prediction formation. Tuesday, 1:20 p.m. Yale analyzed a stock consolidating in a range. He identified what looked like accumulation. His analysis quickly became prediction. This is definitely building for an upside breakout. The consolidation is getting tighter. Volume is showing buying interest. This is going to break higher, probably to $52. I can see it. This is classic accumulation before a move up. Yale had shifted from "this pattern has historically preceded upward moves X% of the time" to "this will break upward." Analysis became certainty. The entry based on predicted future. Yale entered long at $49.30 based on his prediction that the breakout would occur upward. His entry wasn't based on the breakout happening, it was based on his certainty that it would happen. I'm getting in before the breakout because I know it's coming. Better to be positioned early than to chase it. This is going up. I'm certain. His stop was at $48.90, but psychologically, Yale didn't really believe he'd need it because he knew price was going up. The reality contradiction. Price moved to $49.45, briefly validating Yale's prediction. He felt the ego boost. See, I was right. I called this. I knew it was going up. I read this correctly. Then price reversed. $49.30, $49.15, $49, $48.95. Yale's stop at $48.90 was seconds away, but his prediction was screaming, "This is wrong. This isn't supposed to happen. I predicted upward breakout. The pattern says upward. This is just a fake out. It will reverse back up. My prediction is correct. The market just needs more time. I'll give it room to prove my prediction right." Price continued falling. $48.80. $48.70, $48.65. Yale's new stop at $48.60 was hit. He lost $280, double his planned risk, because he defended his prediction rather than accepted reality. The stubborn re-entry. The devastating part. Watch price stabilize at $48.50, then start moving back up. $48.70, $48.90, $49.10. His prediction reasserted itself. See, I was right. It is going up. My prediction was correct. I just had my stop too tight. I'm getting back in. This is the real move I predicted. Yale re-entered at $49.15. This wasn't strategy-based. This was prediction validation-seeking. Price reached $49.35, then reversed again. This time he held through his stop, convinced his prediction must eventually be right. He finally exited at $48.30. Total loss $520, all because he traded his prediction instead of actual price movement. The pattern completion. The cruel irony, after Yale finally exited, price did break upward to $52. His original prediction was eventually correct, but his prediction-driven trading destroyed his ability to profit from it because he was so attached to being right about how and when it would happen that he couldn't respond to what actually was happening. The anatomy of prediction-driven destruction. Yale identified how prediction destroyed his trading. Destruction Pattern 1. Confirmation Bias Override. Predictions created confirmation bias that filtered information. Yale only saw data supporting his predictions while ignoring contradicting data. This made him blind to signals that his trade was failing. When predicted upward movement, every small uptick looked like the start of the predicted move, while every downtick was dismissed as temporary noise. His prediction controlled his perception. Destruction Pattern 2. Risk Management Abandonment. Predictions made proper risk management feel unnecessary. Why maintain strict stops if you know the market is going your direction? Yale's predictions caused him to override stops, move stops, or ignore stops because they contradicted his certainty. Destruction Pattern 3. Reality Denial. When the market contradicted predictions, Yale denied reality rather than adjusted his position. The market is wrong, my prediction is right, thinking, caused him to fight price movement instead of responding to it. This reality denial kept him in losing trades and out of winning trades that didn't match his predicted scenarios. Destruction Pattern 4. Ego-driven trading. Prediction-based trading became about being right, not making money. Yale held losers to prove his predictions correct and exited winners that succeeded for wrong reasons. His ego needs overrode his profit motive. Yale's transformation, from prediction to probability. Yale built systems that eliminated prediction and replaced it with probability-based response. System 1. Language reframing. Yale eliminated predictive language from his analysis. Banned words: will, definitely, certainly, going to. Required words: probability, if then, could, possible. Old: this will go up. New: this pattern has 60% historical probability of upward resolution. If it breaks up, I respond with long entry. If it breaks down, I respond with no position. This language shift changed his thinking from prediction to probability-based response planning. System 2. Scenario-neutral planning. Yale stopped analyzing what would happen. He started planning responses to different scenarios. Instead of, this will break up to $52, he wrote, if breaks above $50, enter long. If breaks below $48, remain flat. If continues consolidating, reevaluate in 2 hours. This eliminated prediction. He didn't know what would happen. He knew what he'd do in each possible scenario. System 3. Prediction Awareness Journaling. When Yale caught himself making predictions, he wrote, I'm predicting X. This prediction is not fact. It's my brain seeking false certainty. The market will do what it does regardless of my prediction. I release this prediction and return to probability-based response. This practice made prediction-making conscious, allowing Yale to interrupt the habit. System 4. Detachment Affirmations. Before analyzing setups, Yale read, I don't need to know what the market will do. I only need to respond appropriately to what the market does. Prediction is not required for profitable trading. Probability awareness and disciplined response are sufficient. This affirmation reduced his psychological need for prediction. System 5. Outcome Independence. Yale practiced viewing his predictions as completely unrelated to actual trading decisions. He could think this might go up while simultaneously preparing equal responses for if it goes up and if it goes down. His predictions became neutral mental noise rather than decision drivers. The breakthrough realization. 8 months into his transformation, Yale analyzed a setup that looked bullish. His brain automatically generated a prediction: this is going up. But Yale had a profound insight. My brain just made a prediction. That's fine. Brains make predictions, but that prediction is irrelevant to my trading decision. I don't trade predictions. I trade probability-based responses. The prediction is just my brain's attempt to feel control. I can let it exist without acting on it. My trade is based on if price breaks up with volume, I respond with entry, not I think it will go up, so I enter. Yale set his entry trigger above the consolidation high with clear if-then logic. He didn't enter based on his prediction. He entered based on price action confirming his if-then condition. The trade worked, but even if it hadn't, Yale felt completely at peace because he'd responded to reality, not traded his imagination. Yale's results, the transformation in numbers. Before probability-based systems, prediction accuracy, 40%, worse than random. When predictions correct, win rate, 68%, often overextended. When predictions wrong, win rate, 22%, fought the market. Prediction-driven decisions cost $8,200 over 3 months. After probability-based systems, predictions made minimal. Brains still generated them, but they weren't acted on. Decision framework, probability-based scenario response. Win rate, 63%, consistent with strategy expectancy. No longer overriding strategy due to predictions. 3-month improvement, plus $9,400 from elimination of prediction-driven errors. Yale's trading became reactive to actual price movement, rather than proactive to imagined future scenarios. His results stabilized because he stopped fighting the market when it contradicted his predictions, and stopped overextending when it temporarily confirmed them. How to break the prediction habit. Your action plan. Step 1. Document your predictions. For the next 20 trades, write down your prediction about what will happen before entering. After the trade, assess accuracy. Most traders discover their predictions are no better than random chance. Step 2. Identify your prediction type. Which type describes you? Directional certainty? Price targets? Timing? Scenario construction? Name your specific pattern. Step 3. Eliminate predictive language. Remove will, definitely, certainly from your trading vocabulary. Replace with if-then, probability, possible scenarios. Language shapes thinking. Step 4. Build scenario response plans. Stop analyzing what will happen. Start planning. If scenario A, I do X. If scenario B, I do Y. Create response plans for multiple outcomes without predicting which will occur. Step 5. Practice prediction awareness. When you catch yourself predicting, pause and acknowledge that's a prediction. Predictions aren't facts. The market will do what it does. I don't need to know the future to trade effectively. Step 6. Implement detachment rituals. Before trading, read, I don't need to predict the market. I need to respond to the market. Probability-based response is sufficient for profitable trading. Step 7. Test prediction independence. Practice having predictions without acting on them. Think, this looks bullish, while simultaneously preparing bearish scenario responses. Prove to yourself predictions and decisions can be separate. Step 8. Measure decision quality, not prediction accuracy. Stop caring if your predictions are right. Start measuring if you followed your probability-based response plan. Successful trading doesn't require prediction accuracy. It requires response discipline. The fundamental truth about prediction and trading. Here's what Yale learned. Prediction and successful trading are not just different, they're incompatible.
Prediction requires certainty about the unknowable. Successful trading requires probability assessment and disciplined response to whatever happens. The market is genuinely unpredictable in specific instances. You cannot know what will happen next. Accepting this isn't defeatist, it's liberating. Once you stop trying to predict, you can focus on what actually works, identifying probability edges and responding consistently to actual price behavior. Your predictions are fiction. Price movement is reality. Trade reality, not fiction. Build systems that respond to what is rather than what you think will be. Stop trying to be right about the future. Start being disciplined about the present. That's how prediction habits break. That's how trading becomes profitable.